Hello to all my students. This is the second topic of MAF 253 titled The Evaluations of Financial Performance. As usual, before we begin our video lecture, please have before you a textbook so that you can refer to it as we go along with the slides. So these are the topics that we're going to cover for this video lecture session. We start off with the definition of financial analysis, followed by objectives of financial analysis, and then we're going to discuss about financial statement, followed by the financial ratios that you need to calculate for this topic. And then we're going to discuss about Dupont Analysis, and then lastly, we're going to cover the limitations to ratio analysis, and then we end our video lecture by looking at two tutorials on how to calculate financial ratios. So what is financial analysis and financial ratios? Financial analysis is the assessment of a firm's past, present, and anticipated future financial performance. The analysis is made based on the firm's financial statements. So one of the tools for financial analysis is financial ratios. Ratios are mathematical aids to evaluate and to compare financial performance, which are calculated based on the firm's financial statements. They are used to summarize the information in the financial statements by assessing the financial health, such as liquidity, efficiency, leverage, profitability, and market performance. So from the ratio, we can look at the company's historical performance by comparing the trend performance over time, as well as relative to its competitors in the same industry. So when we want to assess whether the company is doing well in terms of liquidity, efficiency, leverage, profitability, or market performance, we need to compare the company's ratios either with their last year's ratios performance, or we can also compare the current company's financial ratio performance with their competitors in the same industry. Most likely we're going to either compare it to the industry average, or we're going to compare it to the market leader of the industries. So what are the objectives of us analyzing the financial statements? So the objective is to identify the firm's strengths and weaknesses. By identifying these strengths and weaknesses, the firm can take remedial and corrective actions to improve upon their weaknesses. Therefore, the objectives of the financial ratios are: first, to standardize financial information for comparisons purposes. So once we standardize, the word standardize means is that regardless of what is the size of sales the company has for that particular year as compared to their competitors or as compared to their past performance, the size of their sales, the size of their assets, it doesn't matter, because when we calculate the financial ratio, we are standardizing the information so that we compare them year to year without the size of asset or sales distort our assessments. The second objective is to evaluate current operations of the company. The third is to compare present performance with past performance. The fourth one is to compare performance with other firms or industry standards. The fifth one is to assess the efficiency of the operations. And lastly is to assess the risks of operations. Before we can talk about the financial ratios, we need to understand financial statements. So financial managers focus on cash flows rather than accounting profit. due to the fact that a firm requires cash to make investment to pay for the expenses, liability, interest, and dividends. Okay. However, the firm's cash flows are usually different from its net profit. This is because of two reasons. One is due to the non-cash item, most probably depreciations of non-current assets. So in accounting, the purchase of non-current assets is not recognized as expenses in that year that the assets are purchased. Instead, they are recorded as assets in which the cost is spread over the useful lives of the assets as depreciation, meaning that we do not incur the expense of buying the asset in one whole year. Instead, we spread the cost of buying the asset over their useful life, and we call them as depreciations. Okay, so that's why depreciation is a non-cash flow items due to its nature of spreading the cost for 1 year into maybe 5 to 10 years. The second reason is due to the accounting uses accrual basis rather than the cash basis. It means that the income and expenses are recognized when they are earned or incurred, and not when the cash is received or paid. So sometimes we recognize the sales that we generated for that particular year. However, the amount of sales that we have generated may not be similar to the cash that we receive from the sales, due to the fact that the accounting recognize sales when they are incurred and not when they are received. The next part of understanding financial statement is to know who are the users of financial statements. So we can categorize the users of financial statement into 7 categories. You have already covered this when you did your FAR 110 paper when you were in part 1. So this is just a recap for you, a revision for you to recall who are the users of financial statements. So amongst the user are the shareholders or the owners. It can be either individual owner or individual shareholders or an institutional shareholders. Okay, so what are the owners interested in is the information on the profit earned, so that they can estimate the dividend that they should have received, the financial health and the future growth of the company, because they want to have a high price earning ratio, and then they want to decide whether they want to retain or to sell the shareholder that they are holding on. The second user is the manager. Okay, manager needs the financial statement to evaluate the performance of the company for the purposes of planning, organizing, and controlling. The third category is the loan provider, who use the financial statements to determine the creditworthiness of the company, whether the company can pay the interest and principal back on time. Financial statement is also important to the current and future employees, because they want to know the stability of their job, to know the continuity of the company, and also to know whether there are possible bonuses and increment in salary based on the performance of the company. The next part is the potential investors, in which they use the information to assess the performance of the company as well as potential growth before deciding to invest. Customers are also also interested in using the financial statement, because they want to ensure that the company can deliver goods that they have ordered, as well as giving them guarantees, warranties, and etc. for the product that they have purchased. And lastly, government is interested to know the performance of the company, because they want to ascertain the company's declaration of tax and also make the expansion plan for the economy in the future. Okay, now we come to the main part of the topic, which is to calculate and to understand the financial ratios. So we can categorize the financial ratios into 5 categories, which are the liquidity, the efficiency, the leverage, the profitability, and the market itself. And so the liquidity is referring to the ability of the company to pay back their short-term obligation, such as current liability, using their short-term assets, such as cash. Efficiency is referring to the efficiency, how the company manage their assets so that they can produce more sales or generate more profit. Okay, leverage is referring to how the company finance their operations, either by debt financing or equity financing. Profitability is referring to the level of profitability that the company have incurred for that particular year. And market ratio is to determine for the usage of the investors to determine whether the company is still worth investing or should they sell off their investments. Okay, now we go into the liquidity ratios. As I have discussed before, this ratio shows firm's ability to meet its short-term financial obligations. That is, whether the firm has the resources to pay its creditors when the payments are due. So there are 2 ratios that we can use to assess the firm's liquidity. One is the current ratios. The second one is quick ratios. So quick ratio is also known as acid test ratio. Those are the 2 interchangeable terms to show the company's ability to pay short-term obligations. So if you look at the formula for the current ratio, it says here that the current ratio is calculated by dividing current assets with current liability. So it means that, let's say that when you calculate it, the current ratio is like 2 times. Then the interpretation would be, for every 1 ringgit of current liabilities, the company has 2 ringgit of current assets as a backup. So as long as you have more current assets compared to current liability, then your liquidity standing is deemed to be acceptable. Okay, however, within the current asset, there are assets that cannot be used to pay off your debt. Okay, so the current asset we talk about is the stock, which means that we need to sell off stock in order for us to have cash. Then can we pay for the current liabilities. And another illiquid asset is the prepaid expenses, which can only be received for the next period of accounting. Alright, so when we want to calculate quick ratio, we take off the illiquid assets, aset tidak cair ini, stocks and the prepaid expenses, and then we divide by the current liabilities. Okay, usually it will be much lower than the current ratios. Yeah, for example, if the current ratio is like 2 times, then maybe quick ratio will be much lesser than that because we have taken out stocks and the prepaid expenses. Okay, and the interpretation is similar to the current ratios, but now you use the word quick assets as backup. So why sometimes in the final exam, the question you will find out that the current ratio is 2 times, which is more than 1. However, when you calculate the quick ratio, it becomes less than 1. Maybe that's 0.8 times or 0.7 times, meaning that you have less asset to pay for your current liability. So this is the problem that you must, the problem that the firm has. So why this situation happens is because of the company is holding too much stock. Okay, holding too much stock is not good for you because one, you have to pay more, you have to incur more expenses to maintain and to keep your stock. The second one is we invest stock for us to generate sales. So if you have too much stocks, meaning that you have problem in selling off your stocks. So you need to address the problem of slow moving stock. Okay. And another reason is maybe because you have poor debt collection management. Okay, you like to the company has a tendency to collect debt from their debtors more than longer time for a longer time. So that is not a good way to manage your cash. And another thing is that the company or the firm may finance their long-term projects with short-term liability. Yeah, if usually we often like to use short-term obligations to pay for the short-term assets, and if you want to buy a longer useful life of assets, then we usually go for a longer terms financing. But if you use long-term if you use short-term financing to finance your long-term assets, then you may have problems in terms of your liquidity because the asset that you have financed has not yet yield returns for you. You already have to pay for your short-term loan. That is the problem. Okay, the next is the efficiency ratio. So this ratio shows how effectively the firm manages its assets to generate sales. Okay, it will indicate whether the assets are too high, too low, or in a reasonable amount for the firm's current and projected operating level. Right? So there are 4 ratios that you can see here. One is inventory turnover. The other one is average collection period. The third one is the total assets turnover. And the fourth one is the fixed assets turnover. So look at the formula here. To calculate turnover is you have to divide cost of goods sold or cost of sales is the same thing. Yeah? Cost of goods sold or cost of sales are the same items. And you divide by either average stock or closing stock. Okay. So if in the questions it's given to you the opening and the closing of the stock, okay, is in the cost of goods sold, so you have the information of opening stock, and in the financial position you have the information of closing stock. Then to calculate inventory turnover, please use average stock. So how do we calculate average stock? Opening stock plus closing stock, we divide by 2. Okay. However, you're going to find out that some of the past year's questions that we're going to do later on do not offer you the information of opening stock. There are no information available of how much is the opening stock. So if that's the case, then you are allowed to divide cost of goods sold with closing stock. Okay. So it shows how many times the inventory is being replaced in a year. Okay, so let's say that you calculate, you get 4 times. The inventory turnover is 4 times. So it means that in 1 year, the company replenishes its stock 4 times. Meaning that around 90 days. Every 90 days, they replenish their stocks. Okay, so the higher the inventory turnover, the better is your firm's performance because you are selling your stock faster, quicker. If you have low inventory turnover, then it means that you have too many damaged and obsolete stocks that renders you unable to sell off your stocks. Okay, and you may also have problems in terms of high cost of goods sold. What are the reasons for high cost of goods sold? Maybe you are purchasing your inventory at a much higher price compared to other competitors. You may have low sales, and then you have a low promotion causing you to have high closing. Causing you to have low closing stock. Okay, the next one is the average collection period. Okay. Just now, if you have a high cost of goods sold, then it means that you have high inventories. So you need to address to having too much stock in your keeping. Okay, next one is the average collection period. The formula says here debtors divided by credit sales times with 360 days. So the words credit sales here means only the sales that you sell off to your customer in terms using credit basis. So if there's elements of cash sales in your total sales, you need to take out the cash sales. So it shows how many days it takes for a company to collect debts from its debtors. Okay, so the longer the ACP, the slower it is your policy to collect debt, the lesser the worse is your performance in terms of efficiency. Okay, so we do not want to have high ACP. So why does some company have high ACP? Because of the bad credit policy. Okay, maybe you have too loose of a credit standards, and then there are no aging debtors. You do not keep track on which debtors which have has overdue credit terms, or you do not offer your creditors, your debtors sufficient discount to attract early payment. So we need those debt management policy to ensure that you can collect debt for your debtors as fast as possible, because we want to convert the debtors into cash. The third one is the total assets turnover. The formula is sales over total assets. So let's say that you calculate and you find out that the total asset turnover is 2 times. It means that for every 1 ringgit of asset that you have invested, the company is able to use those assets to generate 2 ringgit of sales. So the higher the turnover, the more efficient the company is, because you can generate more sales using the same amount of assets. Okay, sometimes what is the cost of having too low total asset turnover? Simple. You may invest too many assets, but you do not use the asset to generate sales. So we call that as an idle asset. Asset that you have purchased but do not use. Okay, and then we can specify the turnover ratio into focusing on the fixed asset only. And if you have too low of a fixed asset turnover, meaning that you have too many idle assets. Okay, the third part of financial ratio is the leverage ratio. So these ratios measure the level of debt or borrowings in the firm, whether the company uses more debt financing to finance its assets and operations as compared to equity financing. So there are 2 ways for us to measure the leverage ratio. One is through calculating debt ratio. The other one is to calculate the time interest earned, or sometimes known as interest coverage. So to calculate debt ratio, you can use 2 ratios. One is dividing the debt with total assets, or you can divide the debt with total equity. So in your past year question, if the question asks you to calculate using this formula, they usually will use the term debt to equity ratio as opposed to debt ratio. So if the question asks you to calculate debt ratio, it means that they are asking you to divide debt with assets. So if your calculated debt ratio is 40%, it means that for every 1 ringgit of asset that you have purchased or invested, you borrow 40 cents and you use your own money 60 cents. It means that the firm borrows 40 cents to purchase 1 ringgit of assets and then use 60 cents from their equity. Okay, if for the time interest earned or interest coverage, we use the EBIT or earnings before interest and tax, to divide with interest expense. So the EBIT is also known, sorry, it's not sometimes, it's also known as operating profit. Okay, so please look at the question, whether the question use the terms EBIT or the question use the term operating profits. If the question doesn't give you EBIT, they just give you straight to earnings before tax, please add first the interest in order for you to get the EBIT figure. And then you divide by interest expense. So the higher the interest coverage, the well off you are, because you have more profit to cover to pay for your interest. So what are the causes of problem in leverage? One is because the firm relies too much on debt financing. This is maybe because the firm paid too high dividend that reduce their retained earning, making the firm to resort to debt financing when they want to expand their business. Next is we look at the profitability ratio. Okay. This ratio measures how effectively the firm uses its assets to make profit. It shows the profit earned for every ringgit of sales made. So we have GPM, NPM, OPM, ROA, and ROE. So for GPM, gross profit margin, okay, when you talk about margin, it must be divided with sales. Okay, it must be divided with sales. So if GPM, then gross profit divided by sales. If it is NPM, so net profit divided by sale. OPM, operating profit divided by sales. Okay. So why you have low GPM? First of all, due to low sales, no promotion, no trade discount, nothing you do to encourage your sales. And you may have high cost of goods sold or cost of sales, yeah, due to maybe expensive raw material, right? For the NPM, the reason why you have low NPM is due to high expenses. Company do not manage their expense very well, and of course you have cost of financing too high, because your profit, you're borrowing too much, so you have to pay high amount of interest, causing your net profit after tax to be lower. Okay, if you found out that you have high gross profit margin but low operating profit margin, then you know that the problem lies within the operating profit itself, meaning that the company has problem in managing their operating expenses, such as maybe they pay too much expenses in terms of salary, in terms of bonuses, in terms of depreciation, yeah, too many assets, but they do not use the asset to generate sale, but they still have to bear with the cost of depreciation. So those are the examples of high operating expenses problem. Next, we go to the ROA, where we divide net profit with total assets. So we want to know for every RM1 that we invested in the company, in the asset, how much profit can we generate. If you have too low of ROA, we use the same reason as having a low total assets turnover previously, because you have too many other assets that you cannot use the asset to generate more net profits. That's the problem. Okay, for ROE, it is for the purpose for the shareholders, yeah, for the purpose of shareholders as profit assessment, because they want to know for every RM1 that they have invested in the company, how much profit does the shareholder earn. So if you get 20% of ROE, then for every RM1 the shareholder invests in the company, they earn like 20 cents from their investment. Okay, the last category is the market ratios. So these ratios are also called investors ratio, where they evaluate firm stock performance to its earning, okay, and book value per share. It gives the management indication of what investors think of the company's performance, futures, prospects. So there are 5 ratios you need to know here. One is earnings per share, dividend per share, payout ratio, PE ratio, and dividend yield. So earnings per share, you take your net profit after tax, you divide by the number of ordinary shares. So we can see that for every 1 ringgit, for every 1 unit of share held, the investor earn 20 cents. Okay, if the EPS is 20 cents. Dividend per share, you take the ordinary paid dividend and then you divide by number of ordinary shares. So for every 1 unit of ordinary share held, the investors earn 10 cents of dividend. Okay. For dividend payout ratio, okay, if DPO is 40%, then you can say that the out of the profit of 1 ringgit, the company gives out 40 cents as dividend and they retain 60 cents as their reserve. Okay, meaning that they do not give all of their profit as dividend. They retain some of them for their future project expansion, and they give out some of the profit in the form of dividend. Kpe ratio, it shows how much investors are willing to pay compared to the current performance of the company. Okay, it shows the firms, it shows the market confidence in the company. For example, let's say that EPS is let's say 20 cents, but the market price currently, the shares is currently being traded at 2 ringgit. So why does an investor willing to pay 2 ringgit for a share that only gives you profit of 20 cents? Why are they willing to pay 10 times more? That's the PE ratio, yeah, 10 times more than the current performance of the company. It means that they are paying not just for the current performance, they are also paying for their expected future prospect or expected growth in the future. So the higher the PE ratio, the higher is the investor's confidence or the market's confidence in the company. And lastly is dividend yield. Dividend yield is to calculate the return for the investors. So when we invest in the shares, okay, we invest using the market price, and what the return that we receive is dividend per share. So you take the dividend per share that you've calculated here, you divide by the market price per share, then you get the dividend yield. The word yield here also known as return. Okay, return. Okay, so now we have covered all ratios that you need to know to learn. Next, we look at the Dupont Analysis. So Dupont Analysis is just another way for us to calculate the ROE. Okay, remember the ROE in the previous slide where we calculate them using the net profit after tax. We divide by the total common equity. Okay, so Dupont Analysis allows the firm to dissect the financial statements to assess the firm's financial condition. So we can clearly see what drives the ROE and the interrelationship between the net profit, which is the profitability, asset turnover, which is the efficiency, and the debt ratio, which is the leverage. So we're going to see how does profitability, efficiency, and leverage affects the firm's profitability. So by identifying the cost, the management can manage the firm's resources to manage the return earned on the owner's investments. Okay, so we can calculate ROE by multiplying net profit margin with total assets turnover. The NPM is to represent the profitability, the total assets turnover is to represent the efficiency, and we divide by 1 minus debt ratio, which is represented by the leverage. Okay, so in order for us to have high ROE, we need to have high NPM, high total assets turnover, high efficiency, and high debt ratio. So why high debt ratio? Why is it important for us to have high leverage in order to have high ROE? Okay, because the more you borrow, and if the more you borrow, the lesser will be the equity component. Therefore, the shareholder can claim more of the profits. Okay, can claim more of the profit. So that's why high borrowing contribute to high ROE, because the small amount of equity, meaning that a small amount of shareholder can claim more profitability that the company has generated. Okay, if you times NPM with the total assets turnover, NPM times total assets turnover, you should get ROA, which is another form of profits. Okay, 1 minus debt ratio can also be derived by dividing total assets with total equity. You should get the same amount here. Okay, so if the question asks you, how can, based on Dupont analysis, what can the management do to increase ROE? So you discuss along the line, the company must increase their net profit margin or increase their profitability. And then number 2, the company need to increase the efficiency in managing the asset by increasing the total assets turnover. Okay, and then the company can also say focus more on debt financing as opposed to equity financing, but not to the extent that you are burdening your profit with too much interest expense. Okay, balance in here. We need a moderation in borrowing. Okay, now we talk about the limitations of financial ratios. So what are the limitations in financial ratios? One is it's difficult to determine whether the ratios are bad or good, unless we can compare it. But it is made possible to determine whether the ratio are bad or good by comparing the current financial ratio with last year's financial ratio, or with the main competitors financial ratio. Okay. The second limitation is industry average is an average performance. Is it better to compare financial ratio with the market leaders financial ratio? Okay, sometimes market average is not actually a very good benchmark tool, because of if a lot of company is making an average performance, then the average will drop. It is better for the company to compare it with the market leader financial ratios. The third limitation is difficult to conclude whether the overall ratio is good or bad due to mixture of ratio results. So, for example, remember we have the efficiency ratio. We have 4 ratios to consider. We have the inventory turnover, the ACP, the total assets turnover, and the fixed assets turnover. So let's say out of 4 ratios, 2 are good, the other 2 are not so good. So how do you conclude your efficiency? So is the company's efficiency good or not? Yeah? When you have a mixture of ratio result, it's difficult for us to conclude whether the overall efficiency of the company is good or bad. The fourth one is inflation distorts the company's financial statement from its true value. Yeah? Especially when you want to compare the trend analysis, you want to compare the current performance with the last 5 years' performance. So of course the inflation would play important roles when you want to compare year by year on a yearly basis. So it distorts the assessment that we made. The fifth limitation is different accounting practices among companies make effective comparisons difficult. Yeah, for example, that you are adopting a depreciation based on the straight line method, but your competitor is adopting the reducing balance method. So accounting practices that are different may cause the comparison of the ratio to be inaccurate. Next is difficult for highly diversified company to compare its financial ratio with industry average because the industry category cannot be identified. This is importantly true for a conglomerate companies. For example, like Sam Darby in Malaysia. Sam Darby dabbles in a lot of industries: the property industry, the plantation industry, okay, and the automotive, the consumer product industry. So if they want to compare their ratios, which industry should they compare with? because they have a lot of hands in many industries. And lastly is seasonal factors affects financial ratio. For example, like your year-end sales being higher, so sales volume, it doesn't indicate better operation efficiency, etc. It's just that the season sales is a year-end sale. People go out and buy, causing you to have high sales without offering different management operation management. Sorry. Right, so now we look at the first tutorial question to see how can we answer the question. So this is the financial position given to you. This is the profit or loss statement given to you. And these are the ratio from the industry average. So they ask you to calculate the ratio, the above ratio, 1 until 10. And then they ask you to compare the liquidity, efficiency, and profitability ratio using trend analysis. So this is 2014 performance financial statement. This is last year's financial ratio. So you need to compare current year with last year's to do some trend analysis. Okay, and then state 3 specific recommendations on how to improve the situation. So let's see how we do these questions. Alright, so first of all, they ask you to calculate current ratio. So current ratio, the formula is current asset divided by current liabilities. So where can you get current assets? Look at your financial position. Look at the total current assets here, 470,000 here. Current liability, look at your financial position. Take the total 363,000. You put in the figure, so you should get 1.29 times. For the quick ratio, you need to remove the inventory and prepaid expenses from the current assets. So for the current asset 470,000, please deduct inventory. So there are no information with regards to prepaid expenses. So it's 0. So 470,000 minus 120,000 divided by 360,000. The quick ratio is 0.96 times. So you can see that after removing the inventory, you have lower liquid assets compared to current liabilities. So this is a problem for you actually. Next is inventory turnover. The formula is cost of goods sold divided by average stock. So you look at the statement of financial position. Do they give you any information about the opening stock? No information. You only have the closing stock from the inventory. So you can substitute the average stock with closing stock divided by 120,000. So inventory turnover is 4.48 times. For ACP, the formula is accounts receivable divided by credit sales. So you take the accounts receivable here, 340,000, divided by credit sales. So there are no information given to you as to whether the sales here consists of cash sales or not. So we assume the whole 690,000 is credit sales. So times with 360 days, the ACP is 177 days, which is quite long for you to maintain your debtors. The next one is fixed asset turnover ratio. Sales divided by fixed asset. Take the sales 690,000 divided by fixed asset here. Take the book value here. Do not take the cost value. Take the book value 253,000. So your fixed asset turnover is 2.73 times. For GPM and NPM, you take the gross profit and the net profit here, divide by sales. So you get 38.97% and 9.04%. For the ROA, you take the net profit here, you divide by total asset, which is 723,000. So you get 4.88%. For debt ratio, you take the total debt here meaning that non-current liability plus current liability. So 140,000 times 3 plus 360,000. You divide by total asset, which is 723,000. So you get 69.57% For the time interest earned, you take the EBIT. So there are no EBITs given to you here. You only given EBIT, earnings before tax. So to calculate EBIT, please add back the interest of 100. Add back the interest of 30,000. So you divide by 30,000. This is the figure that you get for the time interest earned. Alright, the next part of the question, they ask you to compare liquidity, efficiency, and profitability using the trend analysis. Meaning that we want to compare this year's performance with last year's performance. So these are the ratios that we have calculated previously. And these are the ratios given to you in the questions. So they ask you to compare liquidity first. So when you want to compare liquidity, please please compare it as a whole category, not one by one ratios. Okay. For example, at Kpe Ratio, liquidity is, you can say that the firm's liquidity is worse than industry average. So you can see how lower their current and Kpe ratios are compared to the last year's performance. It can be seen by lower current ratios and lower Kpe ratios compared to last year's. So for every 1 ringgit of current liability, the firm has 1 ringgit and 29 cents of current assets and 96 cents of quick asset as backup. It suggests that the firms have problems in managing its cash due to holding too much stock or poor debt management system. Right? When you talk about efficiency, you take all three ratios here and compare it properly, in which you say that the firm's efficiency is worse than industry average. It can be seen by lower inventory turnover, higher ACP, and lower fixed assets turnover as compared to last year. The firm replenishes its stock 4.4 times a year, takes 175 days to collect debts from its debtor, and generate 2 ringgit and 73 cents of sales for 1 ringgit fixed asset invested. It suggests that the firm doesn't promote its product, that's why low inventory turnover, has bad credit policy, that's why you have longer ACP, and has too many other assets. That's why your fixed asset turnover is too low. And we talk about the profitability. Look at the formula, look at the ratio, GPM, NPM, ROA. The firm profitability is lower than last year's. It can be seen by how low NPM and OPM and ROA were compared to last year. The firm has high GPM but low NPM. You can see here, the GPM is much higher compared to last year. However, when we calculate NPM, it should be higher, but instead you can see it's lower compared to last year. So now we can see the problem is between the gross profit and net profit, meaning that the problem lies with having too much operating expenses. Okay, or maybe you are borrowing too much, causing you to have high interest cost. That's why you're having too low of an NPM. So these are the template or how you answer the comparative analysis when asked in the final exam later on. Okay, we go to another example of tutorial. So they give you the comprehensive income. It's a long ago question. We don't call it SOCI anymore. We call it as a statement of profit or loss here. And statement of financial positions. Okay, and they give you the information here. It says that credit sales for the year ended was 1.76 million, meaning that out of 2.2 million, 1.76 million are credit sales, the rest is cash sales. And then they give you the information for the industry average, meaning that they need you to compare with the external competitors average. Compute the above ratio, comment on the asset management and leverage by identifying the possible weaknesses and provide recommendation to overcome the weaknesses. And they also give you, let's say that the EPS is 60 cents, dividend payout is 40%, find the following number of shares issued and number of dividend paid per share. Right? So let's see how we do the questions. Okay, again, they ask you to calculate quick ratios, current ratio, quick ratio, inverted turnover, ACP, free assets turnover, NPM, ROA, debt ratio, and time interest earned. Okay, current asset, please take the figure here, minus the, divide by current liability, 300,000, you get 3.33 times. Quick ratio, 1 million, minus out, remove the inventory of 275,000, divide by 300,000, you get 2.42 times. Inventory turnover, cost of goods sold here, 950,000, divide by closing stock, because there are no information about the opening stock. So we have to take to substitute every stock with closing stock, which is 275,000. So you should get 3.45 times. For the ACP, account receivable here is 225,000. Divide by credit sales, 1.76 million. Do not take 2.2 million. Take only the credit sales, 1.76 million times 360 days. The ACP is 46 days. Fixed assets turnover is sales here, divide by, here we take total sales here, divide by fixed assets, 1.2 million, you get 1.83 times. NPM, take the profit here, 405,000, divide by total sales, 2.2 million, 18.41%. ROA is the same because coincidentally, sales and total asset are the same. So 18.41%. For debt ratio, we take the total debt, which is current liability 300,000 plus with bond 500,000 plus with debenture 250,000. Divide by total asset 2.2 million, you get 47.43%. For the EBIT, it's given already to you 625,000. You divide by interest 62,500, you get 10 times of interest coverage. Right? Easy, simple. Okay, they ask you to compare asset management and leverage. So asset management is another word for efficiency. Sometimes the question use the word efficiency, sometimes the question use the word asset management. Those are two interchangeable terms. Okay, when you want to talk about the efficiency or the asset management, look at the inventory, ACP, and fixed asset turnover. And then you discuss as a whole rather than the individual ratio. So the firm for asset management is worse than industry average. Okay, you can see that because of a lower inventory turnover, longer ACP. Okay, however, even though fixed asset turnover is much higher, 2 out of 3 ratios are bad, so we conclude them to be bad. Okay, fixed asset turnover is, however, better than industry average. Okay, but 2 out of 3 ratios are bad, so we conclude them to be a bit worse than the industry average. So what are the possible causes of having low inventory turnover? Lack of promotion, holding too much stock, high selling price. So when you want to recommend to overcome this problem, you just reverse the causes. If you have low promotion, then then you promote, advertise your product, provide trade discount to encourage sales. Okay, adopt effective pricing policy. Okay, review stock management system. For high ACP, the problems are bad credit policy, poor screening. Screening here means you do not choose your debtors. Whoever comes to your business, you just give them credit sales. You cannot do that. You need to screen first your customer whether they are entitled for credit sales or not. And no cash discount given. Cash discount is given because you want to encourage the debtors to pay you earlier than the credit terms. So recommendation, provide the cash discount, review the credit policy, and adopt proper screening for potential debtors. Okay, for the leverage, you need to look at the debt ratio and the time interest earned. So you can see high debt ratio and lower time interest earned. Okay, it's worse than industry average, but not that worse because you still have 10 times of your profit to pay for your interest. Okay, not that worse. It's just that when you compare with industry average, the industry average is doing much better than you. Okay, what are the possible causes? High debt ratio and low time interest earned because you are using too much external financing rather than return earnings. So focus on equity financing than debt financing, or you can review your dividend policy. Maybe you pay less dividend to ensure you have higher return of your earnings. Okay, for last part of the question, they give you EPS of 60 cents and dividend payout is 40%. Find out the following number of issued shares. So you take out your earnings per share formula, net profit divided by number of ordinary share. Put in the available figure that you have. You have the EPS of 60 cents and the net profit here. Look at the past years, at the statements of financial position. Statement of profit or loss. So the net profit in the profit or loss is 405,000. So you divide the two figure, you get the number of ordinary share to be at 675,000. For dividend payout ratio, the formula is DPS divided by EPS. So put in the figure here, 60 cents, and dividend payout ratio to be at 40% or 0.4. So you time the two figure, you get 24 cents. Easy. It's quite easy. So that's the end of chapter 2 for week 2 and 3. I've also uploaded the past year, the tutorial questions for you to do as a practice, and I will upload to you the answer by the end of this week. So please do the tutorial, and if you have any question, you can ask me through the WhatsApp channel, or you can personally DM me in the Google Classroom. So thank you for your time and your patience and your attention.